Hey, everybody. Welcome back to another episode of the Growth Capital Podcast. I'm your host, Justin Dixon, and today we have Frank Baumann on the podcast. He's the Managing Director of Portfolio Management at Cold Bore Capital. He is a U.S. Navy veteran. This is a really interesting episode because we dig into Cold Bore Capital's thesis of working with military veterans, bringing them into their private equity firm, and they hire for traits, and they train for skills, which I think is a very fascinating way to think about hiring talent. And so we talk about their military focus. We talk about their focus on recession-resistant organizations, focusing on B2B services companies. We talk about the market, what they're seeing as far as the kind of spread between what sellers are asking for businesses and what they think is a realistic valuation. And we end by talking a little bit about talent and AI in the private equity world. So let's get Frank on the pod. Interested in hearing conversations with private equity leaders, CEOs of private equity-backed companies, and startup entrepreneurs where they share their stories about their career journeys, starting, investing in, and scaling successful businesses, and the important role that having the right talent plays in building a successful business, then you are in the right place. Welcome back to another episode of the Growth Capital Podcast. Here's your host, Justin Dixon. Frank, man, nice to have you on the podcast. Happy to be here.
Yeah, great. Thanks for having me, Justin.
Awesome. Well, Frank, kick us off a little bit. Let everybody know kind of who you are, what you're up to, and where you are, and then we'll jump into some stuff.
Yeah, absolutely. So Frank Baumann, currently I'm the Managing Director of Portfolio Management for a lower middle market private equity firm based out of Chicago called Cold Bore Capital. We are primarily staffed with military veterans, many of which came from special operations backgrounds or fighter pilots. Myself, I'm a former naval intelligence officer, so I'm kind of an outlier in the group in terms of not coming from those other two backgrounds. But yeah, we focus on the lower middle market, buy and build strategy, primarily in services-based businesses.
Got it. So how did you kind of make the transition from the Navy into kind of PE? Was that kind of always your goal, or how did this all kind of fruition? Because I met one of the, I guess, I don't know if he's a founder or COO but Matt, I met him at a conference. We were talking kind of before recording, and I found kind of Cold Bore very fascinating from an organizational perspective. So we'll unpack a little bit of that in a little bit. But yeah, I'm just kind of curious your journey going from the Navy into private equity.
Yeah, like many transitioning veterans, I didn't really know what I wanted to do when I got out. I thought I did, but I didn't really know. I do come from a finance background, so undergraduate, I got a BS in finance at LSU. Did a year in commercial banking, always knew I wanted to join the Navy. So joined the Navy, did 8 years. And when I transitioned out, I got into a sales role, which was good for me in terms of financially providing for the family, et cetera. But, 6 months to 8 months into the role, I had this yearning to get back into the financial sector. Didn't know what that was going to look like. And concurrently, I was working on an MBA at the time. But looked at investment banking, financial planning, wealth management, things of that nature. Lo and behold, a buddy of mine from the Navy, former Navy SEAL, got connected with Cold Bore as an operating partner, and they were just starting their first fund, first acquisitions, etc., and asked if I was interested to be part of the operating group with Cold Bore Capital. So learned about it, learned about the thesis with both our founding partner, Sergio Zepeda, and our other founder and partner, Matt Schockman, who you mentioned. Yep. Talked a little bit about it and, got pulled into the first portfolio company of Cold Bore Capital back in 2018 and, transitioned into an ops group role a year after that. And then most recently been pulled inside the management company. So it was kind of a weird journey, but for many folks, particularly military veterans who get into PE, Oftentimes it's not what you know, it's sometimes who you know. So that was kind of my journey in some respects.
And that's been their model kind of ever since, right? Is kind of find people that are military veterans primarily, bring them into the fold. Maybe talk about the operating partner model and kind of what that means to Cold War, because I do a lot of work with different private equity, and they all typically have operating partners, most of which are experienced, CEOs or CROs, or
Yep.
you name the C level. But obviously, you guys are a little bit different, so I'm just kind of curious how it works.
Yep. So generally, what we look for is we hire for traits, train for skill. So, much of the investment thesis of Cold War Capital relies upon a operating arm that is generalistic in many respects, no functional expertise, certainly in most respects, no deep industry knowledge, as you alluded to the typical operating partner model. And from an ops group perspective, we pull from the military. Whether you're transitioning out within the next year or you've been out for some time. And the common theme in what we look for is, did you, within the military, whether you were enlisted or an officer, did you operate in an somewhat autonomous role in a resource-constrained environment, and oftentimes in austere environments? And the reason we look for that type of background is you're quick at making decisions, you're resourceful because you have limited resources, and at the end of the day, you have to make a decision, right? You're not relying upon someone to feed you the answers in order to make the decision. You're making that decision at the same time as probably executing whatever that decision is. And so the special operations community is abundant with those type of people, with those backgrounds, that character trait, that experience, and maybe they're soft on the hard skills like Excel work, understanding a profit and loss statement, certain industry nuances that may occur within a specific industry we're invested in. And as a result, we partner with sellers that are selling to us, or executive chairmen that have deep industry experience, and they cover our blind spots. So we look for utility players at the end of the day that we know that have grit and determination and are teachable from a soft skill standpoint.
Yeah. And is the operating partner role a full-time position within Cold War?
It is, yes. Okay. So they are typically assigned to one portfolio company, and they're a dedicated resource for that portfolio company, which ranges. The resource can be used as an interim C-suite manager, executive. It can be special projects management. It can be post-acquisition integration, pre-acquisition due diligence, et cetera. So they're kind of a utility player. Obviously, it depends on the experience, the skill set, et cetera, but they can be plug and play.
Awesome. And then how many operating partners do they have now? Because obviously you started back in 18, so it's obviously been...
Full operating partners, which includes what we call shared services. So we do have some functional capability. We've got some controllers from a financial operations perspective. We have some data scientists, BI, IT folks that assist. We're probably between 12 and 15 full operating partners, full-time operating partners dedicated to portfolio companies.
Got it. And then remind me the criteria that you kind of look for in businesses shifting to the kind of acquisition side.
Yeah. So from a private equity standpoint, obviously, let's talk about size first. We typically look to acquire anything between 1 and 5 of EBITDA and try and scale a platform between 15 and 20. So that's obviously coupling with multiple acquisitions in a single platform plus organic growth. But in terms of industry, we look specifically at services-based businesses from a B2B standpoint primarily. We are not opposed to B2C, but we want more of a heavy concentration on B2B, particularly in services that are of the non-discretionary spend type service. So recession resilient, nothing's recession resistant, but will this sustain in a recessionary environment? And typically that's with non-discretionary type spend. And then obviously we want highly fragmented markets. So do we have the capability to go out and find multiple acquisition targets? Because if it's heavily concentrated in just a few players, it's not a space we want to play in. There'll be low M&A activity, and certainly there's typically some sort of moat that those big time players have provided. We do like spaces that have big players, but then there's a lot of small players involved in that as well. So that's generally what we look at.
Acquisition, right? Your big players could be your sell point.
Correct. They could be our buyer or future buyer. Yep.
Yeah. Is that the strategy, is to build these into, buy a couple of, 1 to 5 million EBITDA that are the same type of service businesses, and then bolt them together and then kind of re-platform and sell them out to a bigger PE? Is that kind of the model, or?
Yeah. So we'll look at, potential buyers of ours are going to be either strategic buyers. So the big players, whether they're publicly traded or just a very large private non-sponsor backed entity, or yes, a true middle market private equity firm. True middle market private equity firms are much better well positioned and capitalized to bring something from 15 or 20 up to 50 to 100, right? And so that's kind of the ideal sweet spot in terms of who we'd want to partner with / sell to upon an exit. And the overall strategy is not necessarily stacking EBITDA, right? But we will conduct multiple acquisitions within a single platform. But we want to ensure when we look to do add-on acquisitions to an initial acquisition that it geographically makes sense, whether we're going for geographic concentration or geographic diversification. It all depends on the investment thesis for the given platform, as well as a product / service mix. That plays into it as well. But truly, we want to see some potentials for synergies. Every acquisition we look to underwrite should be accretive to the overall platform, and that can be accretive in many ways. It can be accretive from an operational sophistication standpoint, from a financial margin perspective, from a further product / service diversification standpoint. So there's many things that we look at. It depends on the specific investment and the thesis that we have that's driving that investment.
And where are you guys right now? From, you started in Fund 1 and Acquisition 1 back in 2018. What fund are you guys on now? Like maybe talk about kind of the growth that's happened over the last, number of years.
Yeah. So, first fund was relatively small. It was a single portfolio company, founder led, startup, lower middle market, primarily friends and family type contributions to the capital stack. I think we raised around $20 million for that initial fund. Fund 2, we are still active in. We have 2 active portfolio company investments, and we raised around $100 million for that second fund. And earlier this year, we started Fund 3 fundraising. And the target is between 150 and 200 million for that Fund 3 raise. And
I'm curious, kind of, what's the market like right now? Are you guys subject to the same things that, other lower middle market private equity are subject to, as far as, higher interest rates are not great for acquisitions? Are you seeing the delta between what sellers are asking and what, you all may think is actually realistic? Is that delta shrinking? Talking about maybe the state of the market right now.
Yeah. So, yes, interest rate, the interest rate environment over the past couple of years has been challenging, right? In private equity, we typically lever most deals we do. It depends on how much leverage you want to take out, but that does have a negative impact, obviously, on cash flow, ability to service obligations. And now that you're having to outlay more of your cash towards those obligations, limits opportunities for growth. Right. And when you talk about the M&A space in terms of hey, where are the multiples and the valuations for these deals out there? I will say that deal flow has not been a hindrance for us. I would say at the right valuation has been the hindrance, right? The gap is narrowing between seller expectations and what most buyers, to include us, feel comfortable underwriting to perform and meet our investment returns. But there's still a gap, right? We've had some success in narrowing and closing that gap by getting more creative in deal structure for more back end type considerations that make sense for all parties. So it's still a tough environment to get deals done. And I think the majority of data that any firm or consulting group has put out says, look, 24 from a deal count perspective is still on pace for 23, which was a subpar year. Yep. Deal count actually is on pace to finish under 24, but deal valuation is on pace to slightly exceed 23. So, the deals aren't getting done just like they weren't in 23, but the bigger deals are getting done. So, I'd say as the interest rate environment starts to come down a little bit, we may see some things accelerate towards the tail end of 24, but more than likely, Q1, Q2, and 25.
Yeah. And then how are you getting these deals? Like, do you have an internal deal team? Are you going direct to seller? Are you getting a lot of your deals from, iBanks and kind of consultants or intermediaries? Like, where is your deal volume coming from?
It's a mix. We do use some brokers, investment banks, et cetera. We do have a deal team. But we're also going direct to seller, even if they're not on the market, so to speak.
Yeah.
And I would say our best relationships, valuations, et cetera, and higher probability of, closing the deal has been through our proprietary approach. It gives us the opportunity to debunk what's common, particularly in service-based businesses, debunk the private equity stigma, right? We are a little different, right? Particularly from a background standpoint. And we also look to incorporate our ops group, which is definitely mostly different than what typical private equity firms, even in the lower middle market, do. So it gives us an opportunity to tell our stories outside of a broker-buyer relationship.
And then the value add or the structure when you go into these deals, are you doing majority buyouts and you're kind of, the founder is kind of pushed to the side, or are they kind of rolling in, or how does the kind of structure work a little bit?
Yeah, we have a mandate for majority control. So we will do majority investment. We 100% love it if sellers want to roll some equity into the overall cap stack. We typically don't push sellers aside.
Yep.
Oftentimes when a seller says, hey, I want to transact and I want to be done with the business, I'd say it's not a great fit for us. I'm not saying it's not a fit for us. It's situation dependent. What's the maturity level of the overall platform, et cetera, to mitigate any risk of a seller leaving. But typically sellers stay on board, assume some sort of a executive level position, whether that be, hey, you're the business unit leader for this operational company. You own the P&L, or they move into, a lot of these sellers, their biggest thing in their career and the way they've gotten it to where they've gotten it is they sell. They're the sales reps for their businesses. And they hate dealing with closing the financial books, HR, payroll, AR, AP, all that stuff is an administrative headache for them. So oftentimes our sellers will say, look, I'd love to stay on board and continue this legacy, ensure that the reputation remains, but I don't want to deal with all this stuff. And that's a perfect fit for us because we want to take that off their plate You focus on what you are best at, and that's client relationship and client growth. So that's the typical story. It doesn't always happen that way, but that's the typical way it goes.
Yeah. Are you, I read this article and I was talking about like the silver tsunami, about all these baby boomer generations that have built these businesses. Typically a lot of them are services businesses, whether they're home or B2B. And they're in the position where they can't sell to PE because they're almost like family, they're paper-based accounting, they're handshake deals. And so if the founder leaves, the business kind of goes away, right?
Mm-hmm.
It's Chuck in a truck kind of thing. And,
Right,
and
right.
so are you seeing some of that where you're getting these kind of folks that don't have a successor? Maybe they're kids, or they don't have kids, they don't want to be in the business, but they don't have a retirement plan because they were so focused on building the business. Like, are you seeing any kind of that kind of correlation to some of the sellers and a vast amount of these services businesses that are being gobbled up by PE all over the place?
Yeah, there's a huge gap right now for baby boomer owned businesses, particularly small businesses, as you discussed, that have no succession plan. And it's because exactly what you said. They don't have a family member they want to hand it off to. Maybe they don't have anybody on their team that can afford to buy it, right? But they want to capture the value that they've built over a generation,
Yeah.
oftentimes. And, you know, a typical private equity firm, even in the lower middle market, may say, look, the business processes, as you alluded to, are too unsophisticated and hairy for us to buy this for anything meaningful. They may offer something, but way too low for what the seller may think is the value of that company. It is a big gap. And so one thing we look at deals all the time where there's lack of systems and processes sophistication, and that's something we can immediately pull the lever on and bring to the forefront for these businesses. So we see it as oftentimes a positive, depending on how big the deal is. Because that's like our post-acquisition wheelhouse is, first thing, let's sophisticate these businesses so we get transparency into what's going on to shorten our decision-making loop, right? And so, private equity alone is not keeping pace. So, I'm not sure if you or your audience is familiar with SBIC funds from the Small Business Administration, but, the gap between it's over $1 trillion in value that's out there in baby boomer owned small businesses. And we're outlaying something like 30 billion a year in SBIC funds. That includes leverage. It might be up to 40, 2024 data is not yet published, but the growth is not the growth of SBIC investing, which has a mandate to invest in small businesses, is not on par at all with what's out there in terms of opportunity. So where does that leave us? That leaves us with its potential that either one, some of these businesses will just close their doors and cease to exist, or a majority of these sellers will not get the true value of what these businesses are worth. We are trying to do our part. We've even partnered with a non-for-profit called Owners in Honor, who specializes in transitioning veterans, finding these businesses to take over. Obviously, pay for them, but it's a gap in the U.S. economy for these businesses to fully transition.
What's the nonprofit called? Owners in Honor?
Owners in Honor.
Interesting. I like that idea. I've done a lot of kind of work on this, like from the recruitment side, is this like succession recruitment is like, there's a lot of these businesses that, like I said, they can't sell, but they want to continue the legacy of their business, even though it's not going to be in their quote unquote family. Right. So, but that's a story for another day, but I like that Owners in Honor focus of helping veterans kind of find and then acquire and operate these businesses. That's super fascinating. I could continue on, but I know I don't want to take up your entire afternoon. So I guess let's shift a little bit to the market and the future. We talked a little bit about kind of interest rates as a barrier here. Like, the next 12 months, if we jumped on a podcast 12 months from now, like, where do you think the cold bore is from a market and from an acquisition perspective? Maybe just talk about that. Looking at your fuzzy crystal ball.
Yeah, I think, let's say this time next year, I think we've made and launched 2 to 3 new platforms with, 3 to 6 acquisitions from our Fund 3 perspective. Those will be relatively small acquisitions, 1 to 5 million. I think we will, despite a declining interest rate environment and forecast it to decline even further, I think we will be more prudent in how much we lever our deals. I think that's probably going to be true for most folks, right? At the end of the day, has a soft landing occurred is the big question that in both the public and private markets are asking. I think most people feel comfortable that relatively so it has, but I think many investment banks are putting probabilities of a potential recession still in the double digits, some even 20 to 25%. So with that's in the back of everybody's mind. And when it comes to leverage, we got to think about that as well, despite forecasted a more favorable interest rate environment. And while we look at recession resilient industries, they're not totally immune to potential downturns, maybe not catastrophic downturns, but either way, it impacts how much you want to lever a deal in order to meet your future commitments. So I think we will, have deployed probably $30-ish million into the marketplace, maybe more, depending on the environment at the end of the day, where multiples are and seller and buyer expectations, and if the gap has narrowed. But I think we're close to that narrowing gap without being creative in deal structures.
No, it's interesting. And I think from a talent perspective, like, where do you, when you go into a business, obviously you look at the financial due diligence of and health of a business that you're looking to acquire. How much stock do you guys put into the existing talent that is there? And how do you weigh that as you're looking at, hey, this is a good or a bad acquisition target? And then kind of off of that, talent from a input perspective, when you're buying a business, let's assume that maybe you need to shift out some of the C-suite. The founder wants to become this chief sales officer kind of thing.
Yep.
I'm just curious from a recruitment perspective, how you think about and weigh talent, as you're looking at deals.
Yeah, it's a big emphasis of ours. As I talked about a little earlier on the podcast, human capital is a big piece of our overall thesis, right? Particularly with what we employ in the ops group. But when we look at deals, right person, right seat assessments are definitely part of that process. We're not in the business of going in and firing people immediately, right? Sometimes you have the right person in the wrong seat. So given some time pre-acquisition, and then, of course, if you make the acquisition, post-acquisition, assessing at least the key people, their overall capabilities and where they're sitting and what their responsibilities have been, what should they be, et cetera. We're constantly doing that, and, pick a managerial system, whether it's EOS Traction or Rockefeller, or OKRs, et cetera. We employ those throughout our organizations. We don't mandate, but typically our C-suites employ those throughout their organizations. And those are great tools to identify overall performance, particularly when it's married up with the overall strategic end state that you're trying to get this company or this platform to. And the sellers and the key people in the organization, we get consensus before we shake hands, sign the paperwork, et cetera. Hey, here's our plan. We want you to be a part of that plan. Here's how we feel you can play a pivotal role in that plan. And, here's how we're going to evaluate each other on that path to achieving. So talent is a big piece. In service, some of these service-based businesses, you do get high turnover with the frontline folks, right? We always try to limit turnover regardless of position. But that's the nature of the beast in some of these industries. But one layer up, a layer above that, that's certainly where we're scrutinizing, do we have the right folks in place? And if not, what's the plan to put the right person in the right seat? And we rarely have to say goodbye immediately after an acquisition, because we want to make best effort to identify, hey, this person's been here for a reason.
Yep.
Are those reasons aligned with what we've discussed with that organization as well as our goals? And if not, then we have mutual discussions, but talent's a huge piece of it.
Yeah, and the services businesses, I started my career in staffing, and I was doing a lot of light industrial manufacturing hiring, and it was not easy back then to find skilled labor folks, and it's even harder now because less and less people are going into it. So I don't envy kind of the post-acquisition turnover, that headache that you guys probably go through on a regular basis as far as that goes. But
it's a big challenge.
Yeah. So I know that you focus on AI or recession-resistant businesses, but also, services businesses are somewhat AI resistant, right? You're always going to need, at least for the immediate future, somebody to turn a wrench, and things like that. So I guess, how are you and Cold Bore thinking about AI as it relates to the platform businesses? And are you implementing or using any type of AI in your business in Cold Bore for evaluation or any kind of like modeling or anything like that? I'm just kind of curious.
Right now, we have not dipped our toe in terms of modeling, et cetera. I will say that, one of our operating partners, he's in charge of our data IT group, Craig Lathrop, who's amazing. He is at the forefront of AI in terms of how to utilize it within our businesses. So, code writing. He writes code. He's got data scientists and engineers that write code. Now, can it completely write code and you can go live with it? No.
Right, no.
But it's an 80% solution to where then you got to look at it and saves a ton of time. So that expands the bandwidth of his team, which gives him more time to support our platforms with their needs. Marketing is a play, in terms of content generation, search engine optimization, et cetera. But, part of what we've looked at, we have not pulled the trigger on it, is how does AI identify and filter your deal pipeline? So if we're trying to build a pipeline, whether it's through both proprietary or sourced deals, what's a quick filter / AI tool that can provide you deals that fit your criteria, your history of success, your, take out ones where you haven't been successful, et cetera. That's certainly something we're looking at. You bring up model building financials. Certainly, we feel like it's going to play a big role in FP&A, the ability to do some of that analysis that we all can do, but takes a ton of time in order to do it. Even with some of the best software systems out there right now, it still takes time. So I believe it's going to play a big role, but we have not yet implemented some of those into outside of coding and on the IT data perspective.
Yeah, I've talked to a few other PEs. I was at a conference in Philly 2 weeks ago, and I was asking them about kind of AI and in their PE firms, and they're still a little reluctant to use it too much just from a data and privacy and all of that stuff. So they have to, essentially anonymize the data for it to kind of like be plugged in, because while I think there are models you can only train on your own data, there are, if you plug it into ChatGPT, that'll go out to the world.
Correct. Yeah. And also I think it remains to be seen the full ROI, because it is an investment with some of these tools.
Yeah.
And so I think a lot of folks maybe be dipping their toes in, seeing how more productive they're able to be, what are the results, et cetera, and then maybe invest more money into it. we're kind of in that discovery phase, I would say, not yet ready to allocate some investment to it.
Yeah, I think that's where a lot of people are, is like dipping their toe, let other people maybe be the fast user or first user, and then let them work out all the kinks, and then go from there.
Yep.
So I want to kind of round out here, Frank, with before I jump into my kind of final 3-pack of questions. I always ask people, like, if somebody's listening to this and maybe they're interested in kind of getting into PE, or they're a military veteran and they stumbled upon this podcast, like what's some advice that you would give somebody that is sitting there listening and is like, man, I really would love to be where Frank is and doing what Cold Boar is doing.
Yeah, I think what anybody can do on their own is just educate themselves, particularly military veterans. I knew of PE because I came from a finance background, but certainly the preponderance of the population, particularly military folks, don't really know what private equity is or does. And then, I think part of what you need to figure out is, am I a numbers person or am I an ops person? And me personally, I kind of fit in both, right? I'm more on the number side, but, I have a propensity to want to do both and be involved in both. So, first of all, educate yourself. What is PE? What's lower middle market? What's middle market? What's upper middle market? How are deals done? What are some of the terms? If you're not financially savvy, even if you're an ops person, you need to understand a profit and loss statement. I know these are rather elementary things, but I talk to military veterans or transitioning veterans all the time, and I say, hey, here are the things you can do on your own. Here's some podcasts you can listen to, etc. And so, it is very difficult to break into private equity. Yep. Whether it's on the ops side, and like you said, most operating partners are these seasoned former executives that are semi-retired, that are on the payroll and, a phone call away for a CEO or a deal team lead to pick up the phone to talk through some issues, et cetera. So there are more and more private equity firms that are looking for generalist MBA type people that can block and tackle, and do the nitty gritty at the, middle to upper management level of a portfolio company. So those opportunities are growing. And so, if that's your side, MBA, I'm not saying you can't get in without an MBA, but that's obviously a big step towards getting there. If you're a transitioning military veteran, give us a call, find me on LinkedIn. I'm happy to have a conversation with you. We might not be able to find a place for you, but we have a broad network of folks where we can find opportunities. 51 Vets is a great organization that specifically looks to place folks in the financial sector, private equity included, so that for transitioning veterans, there are resources out there for sure to get you placed, an internship, and then potentially placed in a full-time role post-transition. So it's the other thing I will say is, most people that are looking to get into private equity are type A personalities, typically don't like to ask for help. Yeah. Reach out to your network. At the end of the day, reach out to your network and see where the dominoes may fall to where they can open some doors for you. You owe yourself to ask for help if you're trying to break into the space.
Yeah, like you said at the beginning, it's a hard thing to break into, but it's also typically, it's not what you know, it's who you know. And if you can kind of 6 degrees of Kevin Bacon get yourself into the right room or on the right Zoom, that makes all the difference.
Yep.
So, no, it makes sense. And I'm assuming you guys use like the Skill Bridge program to
we do.
People out. Yeah, got it. Okay.
Yep.
Awesome. Well, Frank, this has been awesome. I want to kind of transition to the final 3-pack of questions that I ask every guest. It's a little bit not necessarily business specific, but get to know a little bit more about you as a person. First one is what's your favorite business book?
My favorite business book has got to be Good to Great. It's a classic. I've read it. One, I had to read it in undergrad, mandatory. MBA, read it in undergrad, mandatory, and on many deployments in my Navy days, I reread it. So it's always a good read, even if I haven't read it in 5 years. It's something great to pick up, dust off, and understand how you achieve, go that one step beyond being just good and getting to, the most efficient place you can get.
Yeah, it's one of those books that you can read and, to your point, reread 5 years later, and you pick up different things, right? Because your life situation has changed, and yeah, it's fascinating. Awesome. Question 2 here: what is your favorite thing to do away from the office?
So, to give some context here, about 3 years ago, moved to the suburbs of Atlanta. Okay. And apparently my wife grew up here. She told me I'm going to have to learn how to play tennis when we move here, because it's a big social thing. So I picked it up about 2.5 years ago, and I hate missing it. So I love being on the tennis court. It's a great time with the guys, beer and tennis. How can you complain about that? Yep.
Yeah. Yeah, except when it's like, super humid in Atlanta. I've only been there a handful of times, and it's unfortunately I always go when it's like, 95 and 100% humidity or something like that. So
summertime is brutal.
Yeah. Yeah. Well, I live in Austin, so it's just as hot, but it's not as
drier.
Yeah. Awesome. Last question here. What is your favorite vacation spot?
Man, this is a tough one. I will say Charleston Lake, Canada. It's a place, my wife's family has a lake house up there. It's been in the family since, I think, the early 1900s or maybe the late 1800s.
Got it.
It is a low-trafficked lake about 2 hours north of Syracuse, New York. We go every summer. It's my week of solitude. No distractions. It's amazing.
Awesome. I've not heard of that, but selfishly, part of that question is I'm always looking for new places to go check out. So, and I usually have to preface. Some people are like, "Well, if it's the wintertime, I go here. If it's summertime, I go there." So I usually let people offer up 2 spots. But Frank, man, this has been great. It's been great to hear your story and what you guys are doing there at Cold Bore, even more so than I already knew. But if people want to reach out and like talk to you, get to know you and Cold Bore, what's the best way to reach you?
I'm on LinkedIn. Feel free to reach out, connect, direct message me, etc. More than happy to start a conversation, tell you more about myself, tell you more about Cold Bore, etc. So, yeah.
Very cool, Frank. Well, this has been great. I really appreciate you being on the podcast.
Justin, thanks so much for having me.
I hope you found at least one actionable insight from this episode of the Growth Capital Podcast, your one-stop shop for insights from private equity leaders, CEOs, and startup entrepreneurs on starting, investing in, and scaling successful businesses, as well as the role having the right talent plays in growing a successful business. It would be greatly appreciated if you would rate and review this podcast. And if you're watching on YouTube, please like and subscribe and drop us a comment so we can expand the audience of this podcast. Thank you for all your support, and don't forget about upcoming episodes dropping every Tuesday.